everyone, I'm back to bring you another episode of Cheat Codes. Today we'll be reviewing all things bonds, so let's dive in. A bond is simply a loan given to a company or government by an investor. By issuing a bond, a company or government borrows money from investors who in return are paid interest on the money that they have loaned. Bonds are often issued to fund new projects or ongoing expenses. Now pay attention. It's generally accepted that bonds are a less risky alternative to stocks. Now let's use an example. Let's say that your city decides that it could really use a new golf course, so it decides to issue bonds to raise money. Let's say that each bond is a loan for $1,000, which your city promises to pay back in 10 years. The city knows that this isn't attractive to investors, so they also agree to pay an annual interest rate of 5%. The interest rate is also called the coupon rate. An investor buys the bond at face value for $1,000. Each year, the city has to pay the investor 5%, which in this case is $50. So you would be collecting $50 every year for 10 years, or in other words, you would get another $500 added over the length of the bond. Once the 10 years is up, the investor redeems the bond and the city returns the $1,000 initial or principal investment. The city got the money it needed to build the golf course and the investor got an additional $500. Everybody wins. This is why bonds are often viewed as a more predictable and stable form of investing. That all being said, bonds are not without risk. One risk that bonds investors face is the possibility that the issuer defaults on paying back the principal. This is known as default risk. Typically, bonds with higher default risk come with higher coupon rates, or the interest payment that we were talking about earlier. Most governments generally consider strong issuers and issue bonds with a relatively low coupon rate. Corporate bonds, or typically loaning money to a company instead of a government, typically represent a greater risk of default as companies can and do go bankrupt. Credit ranking agencies will typically assign ratings to different bonds. This helps investors identify the financial strength of the bond issuer. But keep in mind that these agencies aren't always correct. It might be smart to compare different ratings of a particular bond. Another risk to consider is what is called interest rate risk. This is the risk that interest rates will go up and any bonds that you own will be worth less before the bond actually matures. This is a little bit complex, but we dive into interest rates in another episode of Cheat Codes, so if you haven't already, go be sure to check that one out. But that's all for me in this episode of Cheat Codes. Be sure to subscribe to our YouTube channel or follow us on IGTV for more tips, tricks, and financial lessons to get you well on your way to becoming a financial superstar.